So we know that low interest rates, historically low interest rates, caused a vast expansion of credit to the mortgage industry, and securitization facilitated the flow of credit and a massive increase in the number of subprime mortgages written, and that many of these loans had promotional interest rates, and after the promotional period, oftentimes these unqualified buyers or less qualified buyers couldn't maintain their debt service, but as long as property values were going up, it didn't matter, because you could refinance or you could simply flip the property and make a profit. And clearly, not too long ago, people thought that real estate couldn't. Some people thought that real estate might never go down. Once it became clear that prices were falling, the default rate soared, and that led to a catastrophic value in the losses value in the mortgage-backed securities. And it's in the cleanup operations that we have started to see widespread, massive quality problems in the underlying loans. I think the critical thing to understand, particularly if you come from an insurance industry perspective, is how the securitization process transformed mortgage lending. When I was growing up in the suburbs of Chicago, in Illinois, there was a law against branch banking. Now, this was so long ago that there was no such thing as an ATM, and we never imagined that there would be. But if there had been, it would have been illegal, because nobody was allowed to conduct a banking business from more than one location. And you could only get a mortgage from a bank. So if you got that guy to agree that you were a good credit risk and he would know the value of the property because it had to be right there in your town, they would hold the loan, and if they did a good job of underwriting you in that property, eventually they'd make money. So then, here's what we had in the last few years. Here's the borrower, and here over there is the person who holds the mortgage, or the people who hold the mortgage. Nobody on this side has any clue about who these people are over here, or who these people are really, or how any of this business actually got generated. This is the originate to sell model, and the parties who originate the loans earn a commission, but they keep no risk, and they pass that risk to investors. And what we've seen over and over again in our own industry is that when you separate underwriting compensation from risk holding, you get what you would expect, you ought to expect. You get higher volume of transactions and worse risks. And now, in the downturn, this is what we've seen, that there are, I mentioned, massive problems in the underlying loans. These include fraudulent or just grossly inadequate property appraisals with loan-to-value ratios of 120% or more for some of the most notorious originators. The loan application fraud rates are also as high as 70% for some originators, and these include misrepresentations of income. If you compare what the person put on their loan application with what they put in their Chapter 7 filing, there's a huge difference. People misrepresented that they were employed and how they were employed. All of these loans were only supposed to be for financing principal residences, but in fact, if you go back and you look at the universe of records, you find that the same person was financing 5 or 6 or 7 principal residences. And I think one of the most shocking defects that's been found is that in many cases, non-performing loans were being ceded to the securitization pools in direct violation of the representations and warranties. The organizers would actually pay the missing payments so that they could call the loan current, because the out-of-pocket monthly payment on the loan was nothing compared to the fees they were earning by putting the package together. So really shocking misconduct in the underlying loans. Again, I mentioned how in the insurance industry we've seen what happens when you separate risk-taking and underwriting. In the 1980s, and this is where I got my start in reinsurance, this happened in the property and casualty business, where companies trying to expand their volume gave their pens to MGAs who were compensated based on commission, and this is exactly what happened to those companies. In the 1990s, this exact same dynamic wreaked havoc on the life insurance industry through workers' comp carve-out. Exact same similar setup, but one part of the industry didn't see what had already happened just a few years ago to another part of the industry. And now we have this again because in the 2000s it was the monoline and the financial guarantee insurers who got into the exact same trouble for the exact same reason. They were lending their balance sheets and basically their reputations to people they didn't know who were producing business in ways that they didn't understand. And by the way, the insurance industry also saw this back in the 1980s when we had this sort of pre-securitization, as far as I understand. But in the 1980s, you'll remember we had the savings and loan collapse. That was another time, not that long ago, when people thought property values could never fall, and when they did, and all the savings and loans, and basically there, loan officers were being compensated based on a percentage of their loans that they originated, and they would always change jobs just before they had to see whether those loans would perform. Very similar dynamic, and when that property market fell, D&O carriers ended up paying a large part of the bill when the federal government took over all those banks and sued to really distort the scope of then understood D&O coverage.